Most people underperform the market for two reasons. Either they are ignorant of what a good investment looks like, or they have an incomplete understanding of how markets behave. A majority of retail investors fall into the first category. If you do not understand how to read financial statements, you either need to go teach yourself accounting, or you should just give up on picking individual stocks. Most people should just buy a broad market index fund, which gains them exposure to a basket of high-quality companies. A majority of investors should just buy the SPY or the VOO and be happy with matching the market. And yet far too often, new investors are drawn in by scummy YouTubers promising them impossible returns. When people are financially illiterate, they are more likely to end up taking advice from scammers and charlatans. Since being financially illiterate is comparable to being scientifically illiterate, let me explain this in terms everyone can understand. Instead of being able to find objective truth for themselves, the scientifically illiterate are constantly forced to ask themselves if they are being lied to, or if the person talking to them is incompetent. This is how people end up as young Earth creationists or flat earthers. In much the same way that people who are scientifically illiterate are unable to tell the difference between objective truth and propaganda, people who are financially illiterate are unable to tell the difference between Warren Buffett and financial education Jeremy. Okay, so the second reason is a bit more complicated. Even people who are financially literate fail to perform well because they have an incomplete understanding of markets. Specifically, I'm not talking about fund managers, but individual investors, because the barriers which prevent fund managers from outperforming are significantly different than what prevents most individuals from finding success. Even if you are financially literate to some degree, you are still likely going to underperform because you have an inherent misunderstanding of how markets behave. This becomes especially clear when I speak to other people who studied business, economics, or finance. I studied markets as a teenager and originally went to college for business and economics. I sat through the same classes they did, and I got fed the same line of bullshit they did. We were all told that markets are efficient, and because they are efficient, we were told we shouldn't even bother trying to beat them. The claim is that prices already accurately reflect all publicly available information. So unless you have some form of additional information that's not available to the general public, you can never consistently outperform the market over time. Some people refer to this as efficient market theory, but it's more correct to call it efficient market hypothesis, because not only is it unproven, it's not true. If markets were truly efficient, then Warren Buffett, Charlie Munger, and Peter Lynch wouldn't be famous. Joel Greenblatt's little book that beats the market might as well be a paperweight, and Monish Pabrai wouldn't have been able to achieve 25% annualized returns since his fund's inception in 1999. The truth is that markets are not efficient. They are dominated by the auction process. Even when presented with perfect information, a majority of buyers and sellers make their decisions based on emotions and not facts. This allows price to swing wildly above and below the intrinsic value of the underlying asset, and it absolutely disproves any notion that markets are efficient. Because the auction process is incredibly difficult to predict, it is best to adopt a stance that markets are probabilistic. They aren't actually probabilistic, but over shorter time frames, they might as well be. Conversely, over longer time frames, the share price is destined to reflect the performance of the company. So it's not that markets are never efficient. The key takeaway here is that they are only efficient over very long time frames. This became especially clear to me when I took classes on how to model complex adaptive systems. So I'm an engineer, and when the time came for me to specialize within my field, I went out of my way to choose a degree that included control theory, because I knew it would help me navigate markets. With control theory, we're told that if we can accurately measure all of the inputs of a system, then we can model its performance. If our model is accurate enough, it can even be predictive. So unfortunately, it very quickly became clear to me that I would never be able to quantify all the separate variables which go into price action. So I gave up on my dreams of solving markets through a modified form of Fourier analysis. But a few core concepts from control theory are still extremely useful when dealing with markets. So if I had to model a market mathematically, it would be like a 15-variable polynomial equation, not something that is easy to model or solve. But if we were able to identify the most dominant variables, we could still make more informed decisions about long-term behavior. By adopting a stance that markets are efficient, a majority of the financially literate find themselves investing into the same broad exposure ETFs that the financially illiterate are stuck with. Worse still, many of them also feed everyone else around them the lie that it's impossible to beat the market. It's difficult, yes, but it's far from impossible. Most people do not have a mental framework for playing low-information games. For those of you who also study game theory, it becomes extremely clear that when one is participating in markets, they are playing a game of both incomplete and imperfect information. A game is considered to have imperfect information if the players are unable to see all of the information which makes up the board state. So, for example, chess and checkers are both games of perfect information, while poker is a game of imperfect information. In a complete information environment, all participants have an understanding of what everyone else's objectives are. This includes things like poker, Monopoly, chess, Battleship, and most tabletop war games. Conversely, in an incomplete environment, players only know what their own objectives are and have to guess what their opponent's goals are. Unlike most games, markets are both very incomplete and very imperfect. Not only are we unable to see the board, we also don't know what everyone else's goals are. In games of both incomplete and imperfect information, finding edge is easy because they are abundant. However, once one adopts the stance that they cannot accurately predict the future, mitigating risk becomes the top priority. This is why experienced investors and traders focus on risk. It is the only variable they get to control. The problems caused by participating in a low information environment become compounded by the fact that we are intentionally fed misinformation. Jim Cramer isn't the only one telling people to buy crappy companies when they are overvalued. A majority of the financial YouTubers are either incompetent, or dishonest, or both. When dealing with markets, it's best to assume that everyone else is lying to you. So once it became clear that uncertainty dominates price action, and it's best to treat short-term price action as if it were probabilistic, those of us with formal educations, those of us who were lied to about markets being efficient, mostly just end up avoiding risk by investing into broad exposure index funds. This is a big part of why people underperform the market. Those of us that are ignorant and inexperienced do not have enough information to make informed decisions. Those of us who are educated, who theoretically should be able to make informed decisions, we are handed an incomplete understanding in school, and at the same time, we're told it's complete. Basically, almost no one is properly equipped to navigate markets. Right, so let's say you took the same economics and finance classes that I did, and you feel the need to get down in the comments and tell me that I'm wrong about markets being efficient. You will likely try to cite some paper or study backing up your claim. The truth is, it doesn't actually matter if markets are efficient or not. What matters is how we choose to behave once we decide to participate. The only way to outperform is to adopt a stance that they are inefficient. I don't want to try to present the image that I'm the most experienced person on this topic. There are people that have been doing this since before I was born. For reference, Warren Buffett and Charlie Munger have both been doing this since before my father was born. But I've been paying attention to markets as a hobby for about 25 years now, and have spent most of that time ridiculing everyone else's analyses. So earlier this year I decided to start writing for Seeking Alpha. Even though these numbers change constantly, I consistently land in the top 15% of financial analysts by performance. So believe me when I tell you that most people are clueless, even most of the other financial analysts. The key takeaway here is that understanding markets is a journey, not a destination. If you ever adopt the stance that you have them figured out, you have set yourself up for failure.